Hi, my name is Scott Rosa. I'm a real estate broker located in Norco, California, which is the IE of Southern California. And I'm beginning this series that's called What You Need to Know with regards to buying and selling real estate. Buyers and sellers alike have a lot of questions when it comes to their transaction and what they need to do to begin it and how to get through it. So what I'm wanting to do is go ahead and give you tips with regards to the real estate market, real estate transactions, anything associated with real estate, and answering questions as well as they come about. So getting started today, we're going to talk about what you need to know for buyers. So as a buyer, the first thing you need to be concerned about is getting qualified with a lender. Extremely important, very critical. You don't know what your buying power is until you know how much you qualify for. So it's important to get pre-approved with a lender. My preference is a direct lender versus a loan broker, and that will be maybe another video another day. But right now, you just want to get qualified with a lender. You should at least qualify with at least two vendors or two lenders, so that you can compare apples to apples to find out that you're getting a good deal for what they're going to charge you to do the loan, and the interest rate, and any other fees that are associated that come from the lender's side. Once you've gotten qualified, I'm going to say pre-qualified, that's basically like a phone call to the lender. And to get transition from pre-qualified to pre-approved, the lender needs to receive all your financial data, taxes, pay stubs, etc. Your offer is a stronger offer if you provide an offer to a seller with a pre-approval letter from a lender. It carries more weight. Also, once you get pre-approved, you're going to know what your costs are going to be in order to get into this house and what type of loan you're going to get. There's conventional loans, there's FHA loans, and then there's jumbo loans. Those are the three most common, and FHA and conventional loans are the two most commonly used loans. FHA is designed for a first-time buyer. You can get in with a 3.5% down payment. The loan is usually a little bit better interest rate than a conventional, but it is more restrictive, meaning the house has to be in a pretty good state of condition. No broken windows, no torn up carpeting, peeling paint on the fascia board is not allowed, things like that. The house has to be in reasonably good condition and ready for move-in. On a conventional loan, it's less restrictive. The house can be in a slight disrepair. The interest rate might be just a slight high, a little bit higher, maybe 0.25% or so. But it doesn't have to. You don't have to go through all the hurdles. You can get into a conventional loan with 3% down, but regardless of what loan you get, whether it's FHA or conventional, you are going to be paying a PMI, which is primary mortgage insurance, on your loan if you put less than 20% down. And I don't care, again, whether it's conventional or FHA. Less than 20% down means you pay PMI. The PMI amount will differ based on the amount of down payment you have. PMI is a mortgage insurance policy. It protects the investor or the bank in case you default on the loan. There's no advantage in there for you. So you're paying it on behalf of them. And here in Southern California, a PMI policy can run $200-300 a month on your average home. And I'm going to say that's like a $500,000 home. So it is a significant part of your payment. And if you can avoid having that and have more money going towards your principal, all the better. Okay, so we'll get into details at another video regarding that. But you do need to know, again, the breakdown of what you're paying for when you're going to buy this house. What type of loan you're going to get, how much you're going to put down. And you also are going to need to know what your closing costs are going to be approximately. Closing costs are beyond your down payment. You have your down payment, and then the closing costs are your lender fee, your property taxes, your escrow fee, your title insurance, and your prepaid mortgage interest payment for approximately 15 or so days. When you're paying your mortgage payment, you pay it in arrears. So you live in the house for the month of March, and at the end of March, which is when your payment's going to be due, technically on April 1st. So that's for the month of March. When you're buying a car, you pay for the payment in advance. For the month of March, you're paying March 1st for your car payment, and that covers you through March. So again, on a house, it's in reverse. When you hear the stories of people get into a home and they're like, oh, I didn't have to make a payment for a couple months. Well, they did in essence because they prepaid it. It's part of their closing costs. You're paying for the rest of that month that you close the escrow within, and then your first payment isn't due until, let's see, so if you close in March, you paid for that in your closing costs. April isn't due until May 1st. So there's your potential month and a half. So good to know. You also want to work on picking out a realtor to represent you. It's important to have somebody that's going to have your best interest at heart, that they're focused on you and not so much on what kind of a paycheck they're going to get. So as you're working with your realtor, make sure you're explaining what your needs are for your family. What, 3 bedroom, 2 bath. The basics are always necessary for the realtor to know. But it takes a few visits for the realtor to go out and look at houses with you, for them to get a feel for, what you like and you don't like, what fits your family and what doesn't. And I'm going to jump back for a moment here. Budget-wise, you may qualify, say, for $400,000 for a house, and that might be based on 2 incomes coming in to the household. I tend to steer my clients to the conservative side of try to qualify based on 1 income. The reason why is because if there's any hardship going on in the economy and one of you get your hours cut or lose a job, Lord forbid, then you're going to have to struggle to make that mortgage payment based on a reduced income and possibly even just one person's income. So if you've qualified for, say, $400,000, and that's based on a 2-income family, and somebody loses their income, and who knows how long that will be for, how do you make that mortgage payment? It's, you may not get the house that you want based on one person's income, but it's the smarter, more practical way to approach buying a home, so you don't find yourself in a situation to where you're going to lose it to foreclosure or to a short sale, having to sell it for less than what's owed because you can't make your payments. They're unaffordable. The real estate market goes through cycles. You can presume or predict that every 10 or 12 years we're going to have a cycle through the market in which values of homes will drop. With that being said, when the real estate market goes through a cycle, the economy is probably not far behind in that same situation. So when the economy starts to do an adjustment, which it always does, then that's going to affect people's jobs and income to the household. These are important things for you to know. You don't want to do the mistakes that people made in the early 2000s, where it's like they were making good money. They were getting these crazy loans that allowed them to do 100% financing to try to get the dream home that they wanted. That was really unaffordable if anything should happen or go wrong. And in this case, as we know from based on history, things went wrong. It happened in the 90s as well. It happened in the 70s. So there's been several times that the market has adjusted. And is it going to happen again in the future? Absolutely. There was just an article I saw where Warren Buffett, I believe it was, or no, it wasn't Warren Buffett, it was the guy's name from Microsoft. Senior moment. Anyways, so he was interviewed and he was asked, is the market going to have another recession? He said, absolutely yes. It's in ink, you can guarantee that it will happen, because that's just what happens with economies. They're an up and down roller coaster. All right, so enough of me preaching about that. You do need to know that you should buy based on one person in the household's affordability, not two. That's my opinion. So that you can ride out any storm when the economy is going flat, in case your family gets hit with a hardship. Talk this out with the realtor too. I mean, if the realtor is being ethical and honest with you, they're going to tell you the same thing. Now, down payment. Again, this is buyers. Depending on what loan you've decided to use, is going to dictate how much of a down payment. And I'm going to use, say, a $400,000 home, since that's been my example. And say you're a first-time buyer and using the FHA loan, and you're only going to do 3.5% down. So that's $14,000, and that price for a home, $400,000, is not it's not an unusual price in the area that I work as a realtor. So $400,000, that puts you at $14,000 for a down payment. Then you have the closing costs on top of that I mentioned. Sometimes you can go ahead and get the seller to pay for all or part of your closing costs. It really depends on the type of market that we're in. If you can negotiate that, if the realtor can negotiate that on your part. So it's really important that you know your market. But let's say hypothetically you're in a seller's market, you're competing with other buyers, so you're more than likely going to have to pay your closing costs, because why would the seller pay yours when they can have another buyer that's willing to pay all their own expenses? So $400,000, I have a little sheet number that I use. It's very rough, so I'm not going to disclose it. It's not an exact, but it gives me a general idea of what to expect the buyers to have in reserves. So on $400,000, I would likely be advising my buyers, make sure you have at least $11,000 for closing costs and $14,000 for your down payment. So that's $25,000 in order to buy a home. That's $400,000 in my area. All right, so that's a chunk of money. Unfortunately, you've been saving. Maybe you had a place and you sold it and you have some equity from a condo or something like that, and you're able to upgrade to a more expensive home. So you want to have your costs prepared and have proof of funds ready to provide with your offer to the seller to show that you have the ability to buy the home. Your letter from the lender showing that you're qualified, that they've seen all your financials, so you're pre-approved. Your offer, and that's something you're going to have to work out with the realtor to structure, how you're going to structure it to look most appealing, and we'll talk about that shortly. And your down payment and closing costs. Okay, so you need to know your market. There's a buyer's market and there's a seller's market, and then you got something that's somewhere in the middle where there's no win for either side per se. Seller's market. What is that? A seller's market is where there's not that much inventory for sale. It's, say, fewer homes, but a lot of people are interested in buying, say when the interest rates are low, as it has been for a few years now. So you have low interest rates, lots of buyers, and not that many homes for sale. So now the seller has an advantage. You're going to have multiple people more than likely interested in that one home and trying to buy it, because there's not that many for sale for them to choose from, so they're being forced to be funneled into just a few homes. Sellers like that because it drives the pricing up. They don't usually have to assist the buyer with anything like closing costs. They can even get away with not doing a termite repair on the house or any other repairs. They can just say it's as is, and if you don't want it, I got 5 other people behind you that want the house, so make up your mind. Buyer's market. Buyer's market is where all of a sudden you have multiple houses for sale. Rates may be a little bit higher, but not necessarily a factor in the equation per se. But you don't have as many buyers shopping. So you have few buyers, lots of sellers, and those sellers are having to compete for those few buyers. This is supply and demand theory. And with that being said, the seller then is more than likely to try to attract you, that one buyer, to come to them and buy their house versus the other 5 down the street. They're probably then going to be willing to negotiate the pricing on their house. They may come down. They may be willing to pay your closing costs or a portion of it. And they will more than likely be willing to pay for a home protection plan for a year, any repairs that come up from your home inspection, whether they're cosmetic repairs or what I tend to focus on, safety or hazard repairs. And they might be willing to go ahead and do a shorter escrow. There's all kinds of things. So anyways, the seller's kind of at the mercy, and they're trying to do what they can to keep the buyer interested in their home and to get that into escrow and to carry through. So know your market, because depending on what market you're in, it's going to dictate how you approach writing your offer. It means everything. You can't be in a seller's market and think that you're going to lowball and get your offer accepted and be insulted if you came in 50 grand under what they wanted and they're like, go fly a kite. No. So, and you're not understanding why your offers are not being accepted because you keep on coming in under. In a seller's market, you have to sometimes go over and beyond even what the house is worth if you want that house bad enough. Which takes me to the next step. When I'm working with a buyer, I'm asking them to go ahead and grade the house. There's 3 different categories I say that you really need to consider when looking at a house. You like it, you love it, or you're absolutely in love with it. What does that mean? Okay, so if you're absolutely in love with it, you're going to do whatever it takes to get into that house. You're going to offer them their asking price if possible, maybe even go over. You're not going to ask for any assistance back. You're not going to ask for any extra a la carte expenses that would impact the seller, or at least their net. You want them to have the most net, so you look the most appealing. And there's other things you can do to tailor that offer. You might not even have an appraisal contingency. You might offer a shorter escrow, 25 days or something like that if you're able to do it. There was days when I was able to do 10 and 15-day escrows when the lenders were able to quickly crank through things. There's enough restrictions now to where that's a little bit more challenging. So you pretty much, unless it's a cash offer, if you're using a lender, you almost have to kind of guarantee or bet that it's going to be minimum 25 days, sometimes up to 45 days, shortest escrow. So where was I going with this? Structuring your offer. And that's if you're in love with the house and you don't want to lose it. If you just like it, well, if you love it but not fully in love with it, then you're going to be a little bit more less generous with your offer. Maybe you'll still offer asking price, but then you're going to ask for a termite clearance. You're going to ask for a home protection plan. You might even ask for a little bit of assistance with your closing costs just to see if the seller will entertain that. And then the lowest category, if it's even on the table, if the house is on the table for writing an offer, is to classify it as that you like it. So you're not loving it, you're not in love with it, but you like it, you can make it work. It's not exactly what your ideal home is going to be, but with a few tweaks and twists and modifications, remodeling, what have you, you can see yourself making it work. Situations like that, I tell my clients, you know what, we're going to go in a little bit under, we're going to ask for everything under the sun, and if you don't get your offer accepted, you're not going to shed a tear over it. So you kind of get the general idea. If it's a house that's being considered, put it in one of those 3 categories, and that will at least then guide you on how to structure your offer before it gets presented to the seller. And also you're going to know where you're at emotionally about that property. Let's see. What should your expectations be from your lender and your realtor? All right. So throughout the escrow process, the lender should have good communication with you as well as your realtor. The lender on a 30-day escrow should be keeping you in the loop as to, okay, we're going to be, because basically the timeline, this is what you need to know. On the timeline for the lender side, on a 30-day escrow, after your offer is accepted, you got to get your deposit into the escrow company. The lender's going to start collecting additional information from you regarding your financials and so forth, whatever they haven't collected so far. They're going to order an appraisal for the house. Typically, you have 17 days to complete your investigations on the house. That's you're doing your home inspection, reviewing all the seller's disclosures that they provided to you, about the house and getting the house appraised to make sure it's worth what you've offered. So the lender's going to get that appraisal along with your financials. They slap it together and then they submit it to underwriting. In the lending industry, underwriting is God. They have the final say so. They're going to review everything, and when they get to the point of approving it, because we're presuming that the lender has done all their due diligence to qualify you and make sure that there will be no huge hiccups that would prevent you from being able to close this escrow. So the underwriting department should be able to approve this file of this home along with your financials. They are likely going to approve it with some kind of conditions. I have yet to see a file that doesn't have any conditions whatsoever that had to be satisfied prior to loan docs or closing. So there will be some conditions, but you've been approved. That loan approval process, you're typically allowed 21 days here in California to complete that. Your offer is going to be contingent, and I'm going to back up a half a step here. When you write your offer and all the stuff that you want in it and the seller agrees to it, your offer is going to have contingencies typically. It's going to be contingent that it appraises, it's going to be contingent that you're satisfied with your inspections, and it's going to be contingent that you get full loan approval from the underwriting department. So you've made it to that hurdle, you're like on the 21st day, and your realtor is telling you now it's time to remove our contingencies for your loan, and you're committing to buying this house at this point. You're moving forward. If you have anything that happens, any hiccup, any reason that you have to back out of escrow after you've removed your contingencies, then you stand to lose your deposit that you put up front, that earnest money deposit showing good faith. Prior to that, while you're in the contingency phase, that's your window of opportunity to decide if this house is a fit for you, and if it's not, then you can back out typically without any financial penalty. It just depends on how your offer is structured. So know exactly what you're agreeing to and what you're offering to that seller as well. Don't just read over everything. Don't trust the realtor and everybody else to say, oh, trust me, you're fine, da-da-da. Know your paperwork. Know this is a legal binding contract. And if you are confused about anything or you don't understand something, make your realtor and or lender and the escrow officer explain it to you until you do understand it. Okay, so 30-day escrow, you've done your inspections, you got the appraisal, it came in, the lender has submitted everything to underwriting. Underwriting has approved you with a few conditions of explain this and provide a copy of that. You're at the home stretch. The next step is that they're going to generate loan docs, and you're going to go in and sign loan docs. That's maybe a 45-minute process as far as signing with a notary. If you have a lot of questions, it may take longer, and you need to understand you're sitting with a notary who does not know your loan. They just know enough stuff about the paperwork probably to be dangerous, but they don't know your loan. So if you have questions about your loan, that should have been asked of the lender prior to the loan docs. So don't expect to go into sign loan docs and your lender's going to be sitting there and you can just be asking questions as you go along. That does not happen. You're going to be sitting with the notary. The notary might even travel to your home to do the signing, and then they're on their way to mail it back to the lender or to the lender's office, wherever that might be. Loan docs are signed and returned to the lender. They review it for accuracy and correctness. In that signing, you're also going to find out how much money you need to bring into escrow. You've done a deposit up front. Now it's time to go ahead and pay the balance. The rest of your down payment and your closing costs or anything else that you've agreed to as far as expenses to the buyer. You need to have all your money in there first. Once you've had your money in there, escrow or the title company is going to confirm that your money's in, and now the lender can fund the loan usually the next business day. But your money has to be there first before the lender can go ahead and put their money into the escrow. Once all monies are there, then it's sent to the county recorder's office to record, and that's considered your closing. All right, so now you legally own the property. And then according to your contract, depending on how it was structured, will determine on when you get the house. If the house is occupied by a homeowner or the seller, then out of out of kindness, you're basically typically going to let the seller have up to about 3 days to vacate the property. They may want to do a rent back for a little bit longer period of time. They could possibly even be out sooner. It just really depends. But typically, an owner-occupied property, you give them about 3 days. That way, they know for sure the house is closed escrow, and they're not moving out prematurely, because anything can happen right up to the 11th hour, where it's never a done deal until it's a done deal. I've had an escrow at the 11th hour fall apart because the buyer lost his job the day before, and when the lender did their verification call to verify that the buyer was still employed, the employer said, no, it was laid off yesterday, sorry. So the deal went south. And this literally was the day before closing. Anything can happen. When it's a done deal, then it's a done deal. And I always try to work or expect the worst case scenario so that anything after that is hopefully going to be good. So my point is, the seller's going to want to know that that property is closed before they typically move out, and go through all the expense and hassle of packing and moving out of the house. They need to leave the house free of any personal property. There should not be anything left behind, no debris, no personal property, no bad broken down mattresses, no transmissions in the backyard, no debris is left behind. Anything that was physically affixed to the property, light fixtures, appliances, with the exception of the refrigerator, but appliances, trees, whatnot. I've had it one time when I first started real estate where the seller they had Sega pumps along the side of the property. They did not disclose to us, where I was representing the buyer, they did not disclose to us that they intended to take those Sega pumps. And there was literally like 24 of them. And they're expensive. So we go to get the keys, and I'm going to deliver the house to the buyer. We get there, and all the Sega pumps have been dug up. Well, needless to say, the seller had to buy us new ones because they didn't disclose to us that they were taking them, so therefore we had an expectation that they'd be there. Anything that was affixed to the property, my point is, needs to still be there. Your expectation should be that the house is in the same physical condition as it was when you viewed the property and made your offer, unless any repairs were agreed upon, and then those should be completed. Which, by the way, I forgot to note on my little paper here, repairs. After you've done your inspections, we're jumping back a moment, and you've had a general inspector look at the house, and they come back and they got all this stuff. You really should stay focused on safety and hazard type items. Everything else is cosmetic, and all contracts show that the house is sold in its as-is present physical condition, regardless of its age. Buyers sometimes don't realize that. They think that after you have an inspection, then they see a laundry list of things that the home inspector called out, many of which may be just deferred maintenance or cosmetic. The buyer thinks that they can go ahead and say, well, here, Mr. Seller, fix all this. That's not how it happens. No, you bought it as is. You're asking the seller if they would consider fixing something, and by all means, that's great if the seller is willing to, but you're probably going to insult them, and they're not going to be cooperative if you give them a laundry list. So you're best off sticking to things that are a safety issue or a hazard issue. Those are legitimate concerns. You don't want to move into a home with your children or whoever and have safety or hazard things in place, like exposed wiring or leaky plumbing that can cause mold. I mean, there's a number of things, but safety hazard related stuff, you can ask for that. The seller is not obligated, though, to do it. And then at that point, you got to make a decision. If they say no, do you still want this house? Is this a deal breaker? And this may be a different video, a different discussion in better detail. So, anyways, at the delivery of the house, free of debris, any repairs that were agreed to need to be done. And I'm also going to throw one more thing in here. If there were repairs that are agreed to, 5 days before you close escrow, when you're signing your loan docs, is about the same time frame that your agent's going to say, okay, we need to do a final walkthrough on the house to check its condition. It's about 5 days before closing. At that point in time is when you need to verify that all repairs have been completed. Because if they haven't, and you close escrow, you really have no leverage over that seller to fix those things anymore. You now own the home. The seller's got their money wired into their account, and they're gone. It's like, see ya. So The only way that you have leverage to get repairs satisfied is, again, making sure that they're done before the close of escrow. And if they're not done, then don't close escrow. Hold up the escrow. Delay it. You have the ability to delay the escrow from closing, and that will encourage the seller to cooperate with getting done what they contractually agreed to with you in a repair request that they accepted and agreed to. All right, so that's a nutshell timeline of things that will happen if you're a buyer, what you need to know, what you need to be prepared for, and hopefully this will give you some things to think about as far as questions to ask. Obviously, if you're in this local area, I'd love to be a realtor and represent you, and give me a call. I'm right there. But if you're not, in general, these are things that you need to be asking the realtor and even the lender so that you're well informed, better prepared, and don't have any surprises. Every escrow may have a little small fire here and there that has to be put out, but for the most part, we don't want something disastrous. We don't want something to blow up in your face. And if you're like me, I do not like surprises at all, especially if it's a surprise that means things are going south. So I don't do that very well. Send me an email if you have questions, if you want me to elaborate on something, if you want me to discuss something in more detail. I'm more than happy to, since this is new for me. Email address, Scott at hotpropertiesre.net. So again, Scott at hotpropertiesre.net. That's my email address. Send me a question. I'm more than happy to go ahead and help you out and answer that. And hope you all have a great day.